Hey, good morning everyone. This is Troy Eckard with Eckard Land and Acquisition here in Allen. This is going to be another continuation of my attempt to work with each one of our older and newer partners on becoming more familiar, educated, and informed about how mineral rights work. Today we're going to talk about understanding the royalty percentage. Now, I'm going to put this in as simple a context as I can. I'm going to use a little bit of diagrams, but I'm going to try to keep it where you really do kind of get what goes on when a mineral right is leased and what retention of royalty percentage that we keep and how that's kind of determined. So let's start off with the basics. I'm a mineral owner in Oklahoma. I own the surface, I own the air rights, and I own the mineral rights. Oil company comes along, knocks on my door and says, hey, we would like to lease the rights to develop your minerals. And I say, that sounds great. Let's cut a deal. The oil company, based on the market value, the perceived value, the competition, they're going to make me an offer. They're going to say, okay, Mr. Eckard, we want to lease your 100 acres of minerals. In today's market, we're paying a $1,000 per acre lease payment, good for 3 years. And if we don't drill a well within 3 years, the mineral lease is expired and it goes back to you. Fundamentally, I, the mineral owner, I own 100% of all the natural resources below my 100-acre farm. But I don't have the money. I don't have the skills. I don't have the wherewithal to develop, mine, drill, or explore for the oil and gas and all the other natural resources under my property. So I may have a mountain of gold, a mountain of water. I may have incredible amounts of oil and gas. I don't have the ability to get it out. So therefore my minerals are essentially worthless from the standpoint of whatever oil and gas or minerals are sold and mined and developed from that property. So the oil company says, I'll give you $1,000 an acre. I got a 3-year lease. That's great. I'll take the $1,000 an acre. That sounds really good. I get $100,000 cash. The second part of the negotiation is the royalty percentage. What does that mean? Well, as the owner, I'm going to receive or retain a percentage of all future revenue from the sale of natural resources under the minerals that I've leased to that oil company in this example. So the leases are going to come at either generally somewhere between a 1/8 or 12.5%, and they can be as lucrative to the mineral owner as much as 25%. In fact, I've seen some mineral owners in West Texas and Louisiana keep as much as 30% of all future oil and gas sales and revenue in the form of a royalty payment because it's in high demand, there's competition, etc. In many cases, the oil company will pay more cash up front to get a higher royalty. So let's say $1,000 an acre will get me a 12.5%. But that oil company may say, I want more of the reserves and I want more cash flow, so I'll give you $2,000 an acre bonus if you give me a 3/16, and I'll give you $4,000 an acre if I get a quarter royalty. Why would they do that? The oil company has already determined in their mind how much oil and gas is in place. They've determined what the value in cash flow and reserves are, and they're trading today's dollars for a higher royalty percentage. Now, Eckard Land and Acquisition, when we go out looking for minerals, most of the minerals that we see, that we have the opportunity to acquire, already have an existing lease in place. Here's how it works. If the oil company comes and leases Troy Eckard's 100 acres of minerals, and they actually drill a well and establish commercial production, by virtue of that development, by virtue of completing the task under the lease agreement of commencing commercial operations, they now control that lease in perpetuity as long as they continue to develop it and as long as there's commercial oil and gas production from the lease. So for me, I have an agreement set in place that may last 50, 100 plus years. A lot of the minerals that we've been buying the last 4 years already had existing leases from vertical wells drilled in the 1950s or 60s, and the oil company who's currently developing the horizontal wells is abiding by the original lease agreement. All the economics are played into that. Let me show you how this works. If we go out today and we find a mineral lease, let's say at an 8, and in the next mineral lease we find at 18.75 or 3/16, it's got 50% more of the reserves than the 8 had. It's got 50% more of the cash flow than the 8 had. So I'm looking at that as a higher valued mineral acre than I would a mineral acre that comes at an 8. Why? I get more cash flow, I get more reserves, it's better, so I'm going to pay more for it. The same thing happens if I drop down and I find a 25% or 1/4 royalty. It's double the value of an 8. I'm getting twice the reserves, twice the cash flow, so I'm going to adjust my price accordingly. Here's an example at the bottom. If I get a 1/8 mineral acre and I'm going to pay $15,000 an acre, and The next person next to him in that same section producing unit says, hey, I was smarter. I didn't need the cash. I kept more royalty because I thought the reserves were worth more than the short-term lease bonus they were going to give me. So I negotiated the 3/16. Well, your lease, your value is worth, to me, 50% more than the 1/8 mineral. Because why? I'm going to get more cash flow and more reserves. And again, the simple math is, if I have somebody an 8, somebody 3/16, and the next guy says, I got 20 acres in the same unit, but I had negotiated a 25% royalty, to me it's worth twice the value as an 8 because I'm going to get twice the reserves and twice the cash flow. Now let's talk about the way Eckard does this so you know within your entire portfolio, miniature portfolio, overall Eckard Land and Acquisition Holdings, you're going to have mineral acres at an 8, the 3/16, 20%, 25%, and we really don't care because what we do is we adjust the purchase price, we adjust the value based on what we're going to have to pay relative to how much we're going to get in the form of cash flow and reserves. Now, this is all important for a couple of reasons. Eckard believes the value of the reserves in the ground are worth tremendous more value long-term than today. We're not so interested in if we pay an extra $500 or $1,000 per acre. We're not so interested in if we pay maybe $2,000 an acre if we know that there's going to be 4 or 5 or 8 wells drilled per zone and there's 3 or 4 zones in place. Because why? In our model, we only value what we have as a known factor today. Wells online, permitted wells, drilled and completed, and formations that are already proved producing. So in our evaluation, we're not only adjusting the price we pay based on royalty, we're adjusting it based on the oil company who leased those minerals and their intent to develop the different reservoirs, what kind of density, how many wells they're going to put, and what that timing looks like. So we modify our prices accordingly. So let me give you a visual that I think will help a little bit, okay? So if this is 100% of the minerals I own, and I'm going to negotiate a 25% royalty, right? Okay, the oil company keeps 75%. They're going to pay 100% of the cost. That's called working interest, okay? They're going to pay 100% of the cost to get only 75% of the revenue. Because I'm a smart mineral, I cut a 25% royalty. My royalties are worth more, my cash flow is worth more, and my reserves I retain that go to my account are worth more. And then all you're going to look at from a visual perspective is, if I take an 8, well that's half, and a 3/16 adds a little bit more. So what you're seeing is, in a complete analytical economic analysis, our team is looking at proof of concept, proven reserves, retention of reserves, cash flow, what the royalty looks like, and how much of that pie we're going to retain. The key for me in all of this is I simply adjust the capital outlay according to what I'm going to get. And I think that's really important for you to understand because each portfolio, when we combine 20 sections of land, 7 operators, 7 lease agreements, each one of those leases and agreements come with different royalties. We blend it all together to come up with one blended average royalty interest across all the sections, and that's where you see that in the map book and in the investment package is, out of all those sections, here's your average percentage, here's the cost per acre, because we know across all those sections, we have somewhere between a 12.5% and maybe as high as a 25% royalty interest. I hope this is a little more clear for you. I hope this makes you understand a little bit why the percentages vary, but at the end of the day, it's all about adjusting the economics according to what you're going to get at the end of the negotiation and the acquisition of any particular mineral section. Hey, listen, I'm Troy Eckard with Eckard Land and Acquisition. Thank you for listening. I hope this clarifies a little bit about understanding your royalty percentage. Thanks again.